Fortinet is down almost a third of its price in the past 30 days. Yesterday, it went down by 25%. Huge drop, 27% in 2 days. That's kind of crazy. And I bought it. I bought it, and today I'm going to be talking about it. A lot of people that you see on YouTube when making videos, they're saying, oh, I bought this and I bought that. Well, I want to first of all say with what money I bought it. Because it's one thing to get the money out of pocket and buy something if you had a little bit of money aside, and it's another thing to manage your portfolio where you sell some positions to buy some other type of stocks that went down or up, or whenever you decide to make some moves in your portfolio, you allocate capital differently. So first of all, I sold Qualys. It was around 8% of my portfolio as of yesterday. Now it's sitting at 3.8%. And I bought Fortinet with it and some other cybersecurity stocks such as Tenable and also Rapid7. Today we're going to be talking about Fortinet. This is not the first time I invest in Fortinet. I have invested in 2023 when it dropped around $50. Bought it around here and sold it at 75, something almost a year later, 74, 75, somewhere around here. It's been going up a lot more after I sold it, and now I have the opportunity to get into it again. And we're gonna be talking about the stats and also compare it to the direct competitor of Fortinet, which is Palo Alto Networks. I have this page ready to go. But yeah, let's take a look at the stats. Market cap $57 billion, PE ratio of 30, forward PE of 28. Double-digit growth rate in the top line. Very consistent high growth. And not a lot of cyclicality. You can see small dips from quarter to quarter. Some quarters in the year are better than others, but it's not super smooth, but it's pretty consistent across the board. So we just want to understand a little bit how they get the money, how they make the revenue. Is there any cyclicality to the business? And there is, because they have cyclicality on their hardware part of business. They sell actual hardware. So that part of their business has a little bit of cyclicality, and then they get a lot of money on services, recurring revenue for services. But yeah, that's not. We just want to understand what's going on. Shares outstanding. They've been buying back shares quite a bit, and their share count has been going down by, let's take a look at annual, by quite a bit in terms of percentages. 2022, when the stock dipped, they were able to buy back some more shares, also in 2020. And then 2021, when the stock rallied, they bought back less. So here's 2020. They bought around more than 4% of their total shares. Stock rallied a lot by 200%, and they slowed down in buybacks. So this is exactly what I want to see. A management preserving the cash of the company when the stock price is soaring, and then when it goes sideways like this and gets into a downswing, then it starts to buy again. So we see here minus 3.6% in 2022 by the end of December 2022. So it offered a very nice floor to the price. And they bought shares back at a better price than it was after it immediately soared. So this is what I want to see from the management, buying back shares when the price is going sideways or is collapsing. When the shares are cheaper, that's when I want my money to be deployed, basically. The free cash flow, not my money, but the company's money. And I have a part of that by buying stock in the company, of course. So yeah, we're gonna also take a look at cash flow to see exactly how much they've been buying back compared to the market cap of $57 billion. But let's take a look at the balance sheet. fortress of a balance sheet. They are sitting right now on $3 billion of cash and cash equivalents. That's great. All-time high cash pile. Why is that great? Well, after the stock price plummets by 25% in a single day, and I have my company that has shown to accelerate buybacks to support the price, and to accelerate buybacks when the share prices are cheaper. And now they're sitting on an all-time high cash pile of more than $3 billion. This is the exactly the situation I want to get in, because the share price is not going to stay down for too long. As you can see here, yes, it can crash violently, more than 35% of the time, more than 1/3, but it's just not going to stay there for long. So in less than a year, I made 50% on my trades in less than a year. And I wouldn't say it's necessarily all because of buybacks, but it certainly helps to take into equation. It's a small part of the equation. Obviously, growth is very important, and other factors as well. We're gonna take a look at some other stuff. Total assets going up over time. Total liabilities going up, but also slowing down, flatlining. So we expect to see shareholders' equity increasing. So yeah, it has been increasing, all-time high. Trailing 12 months, $2 billion. Usually with these tech companies, you're not going to have a lot of equity in the company, but you never have a lot of debt either. So this is not a super capex intensive company. They do offer hardware, but as you can see, they have never been into debt. Always net cash positive. A low of $1 billion. I guess they were buying back shares in this period, depleting their cash reserves. Now they're sitting at a positive of 3.5. Again, very good stuff. Like I said, I already invested in this company. I know quite a bit about it, and also about the competitors. And we're gonna take a look at Palo Alto Networks just to compare. So net income, you always want to take a look at net income whenever you're dealing with tech companies. Actually, you always want to take a look at both net income and free cash flow. But what you want to take into account when it comes to tech companies is that they do excessive stock-based compensation in a lot of situations. I wouldn't say in a lot of situations. A lot of companies do excessive stock-based compensation. So you need to be aware of that whenever you're invested into a company. Are they doing excessive stock-based comp? Or are they not? Because that's just going to eat into your net income. And yeah, I mean, the company might be high growth, but it also might be very highly priced. And if they don't have a lot of firepower, it's just not going to be good for you. I mean, you're going to be swinging a lot. I'll show you the stock price of CrowdStrike in a moment, a company that does excessive stock-based compensation and is very overvalued. But yeah, net income, $2 billion, stock-based compensation, a little bit more than 10% of the net income, 266. So when we take a look at the free cash flow here, it's $2 billion. The free cash flow does not take stock-based compensation as an expense. So it adds back the money spent on SBC as a non-expense. So you see here, oh, it's free cash flow positive in a lot of situations. Oh, they're making money. They're free cash flow positive. But when you subtract the stock-based compensation, they might be negative. So I'm interested in getting a return, and getting a return consistently in free cash flow. That's why I invest. I'm looking for cash flow, but also real cash flow. So I always subtract stock-based compensation, and I always prefer to look at the net income. But anyway, $266 million for a company that is growing double digits in revenue and also has a market cap of $57 billion. Top line is more than $6 billion. Is very decent. I would say is actually very low for this type of growth and high quality that Fortinet is, because let's take a look at the margins. This company is very high quality, more than 80% in gross margins, and climbing. 10 years ago was at 70. Even a few years ago, 2022 was 75. So it's improving in the fundamentals. Operating margin, as you can see here, climbing and climbing and climbing. We're sitting at around 30%. Very high quality company, much better than you would say that this is purely a software company, but it's not. Profit margins 30%, free cash flow margins 32%. Let's take a look at the cash flow statement again and look at the repurchase of common stock. So they've been doing $2 billion in 2022. And as you can see here, they've been slowing down a lot. Like I wouldn't say predicted, but I had a feeling this was happening because they did the same in 2021. But they slowed down a lot in 2024. Let's take a look at the price action 2024, starting 2024. Yeah, it did go up by a lot. And now sitting on a super high pile of cash, all-time high. I would expect this to accelerate again. Maybe we see more than $2 billion of repurchases again, especially if the price continues to plummet. I wouldn't say this is the end of it right now. It might drop a little bit. What I would like to see is a small rebound in the stock price. Let's say it gets up to around 80 in the next few weeks, and then it drops again, and then I'm gonna probably sell some more of my Qualys to pile in on Fortinet, because Qualys it has a slower growth. It is also a very high quality company, but it's a slower growth, and it's a smaller player overall. It doesn't cover all aspects of cybersecurity. Anyway, let's take a look at valuation. So market cap, it had a high of 59 billion in 2021, got rejected there, went on a downswing, stopped at around 38 billion. June 2025, it got up to around $80 billion, 81. Now it's sitting at 57. Can it drop some more? Sure, it can. I'm already happy about buying it at this level. I might buy some more when it drops some more. I'm ready to buy some more. Forward PE 29, all-time low. Considering the growth that this company has, this is not high at all. P ratio of 30 right now. Also, it seems to be at a not all-time low, but in the last 10 years of the company, yeah, for sure, we can say all-time low. It's at all-time low valuation. Price to sales of 9, not at an all-time low, but still much better than it was 2021 bubble. Let's see, EV to sales, EV to EBITDA, all-time low when looking at the last 10 years. So we're getting it at a very decent and good valuation for this type of growth. Now, this is what I like to see. I'm very impressed by this. This is very sweet to see. Okay, return on invested capital, ROIC, going over 100%. That's very nice to see. Obviously, this is not sustainable. Unless something very weird is going on. I was invested in some other company that had ROIC over 500% for many years. Very sign, but yeah, I'm not sure what's going on there. But nevertheless, 37% this year, 40% last year. This is very, very high. Much, much higher than the S&P average. We're looking at around 8% for the S&P, maybe even lower. Return on capital employed, also very high numbers, and a little bit more sustained. It went up a lot in the last few years, and now it seems to be stabilizing at around 30%. This is great to see. FCF yield, how much we are paying for the company, always compared to the S&P 500 and also the competitors, which we're going to look at in a second. So 3.5%, we're getting it cheaper than we would compared to S&P 500, compared to the index. The index is a little bit below 3%. So a very high growth company, double-digit growth rate with amazing stats. What do I mean by stats? High margins, high return on capital employed, high return on capital invested, low stock-based compensation. The management is good. They're not stupid. They're accelerating buybacks when the share prices are cheaper. They don't have any debt balance sheet. If you take a look here, since this, actually not since this company has gone public, but the last 10 years, I can only see the last 10 years here. In the last 10 years, they've only been net cash positive. So amazing reasons why you should own this. But obviously, deciding what to own is just the first part. When to buy it is a lot more important. And now, when it comes to making money, when to buy stuff is a lot more important than what to buy. Because the way I make money, for example, is I buy low and I sell high. But I also want to be owning very high quality companies, which this is a very, very high quality company for me, for my taste, for my own personal criteria. So let's take a look at Palo Alto Networks. Same kind of growth. You could say, oh, maybe it's a bit bigger, but whatever, it doesn't really matter. What I want you to see here is also net cash debt. They have less net cash than Fortinet, while being almost a double, actually more than double, in market cap. And we're going to be taking a look at the net income. It was net income negative for most of the last 10 years, which is, I don't like to see. This is the problem with excessive stock-based compensation. I hate to own this type of company. Seeing just negative net income. Free cash flow, they're positive, but if we take a look at stock-based compensation here, a lot higher than Fortinet, more than 4 times higher, trailing 12 months, 1.2 billion compared to 260 million. But the market cap is just double. Okay. So they're doing a lot more stock-based comp. Free cash flow, it's nice. It's positive across the board. Last 10 years, 3 billion last year. So you would say, oh, this is great. You really need to take into consideration stock-based compensation. Don't get excited over one number. You need to take the whole picture into account. Let's take a look at market capitalization action over the past 10 years. 2022, it was 55 billion. Did not have any significant downswing, so probably a lot less cyclical than Fortinet, and their guidance is much better overall. So the market appreciates stability. Yeah, even if I wanted to own this, I don't see any opportunity that I could have. I mean, maybe in 2024. Let's take a look at the share price. Palo Alto Networks. Where could I have bought it? Yeah, in the last 5 years. Yeah, maybe on this dip, 20%, or maybe here, if I would have caught it. But yeah, it's not. Or maybe here, a bunch of time has passed, moving sideways. Yeah, I guess when everything went down, but not even here. In this period, you would have had a lot of other opportunities to buy amazing companies. Think of Netflix at a dirt cheap price, and Facebook, Meta. I was involved in a bunch of other companies that were a lot more down in price. Even Nvidia was down 70% around this period. So what are we talking about? I'm not going to buy this company over other monsters that were available at that time. PE ratio 97. Is this real? Yeah, I don't know what's going on here. It seems kind of skewed. But yeah, in the high 30s, low 40s, now 97. Something happened here with the earnings. Yeah, I don't like to see this. Forward PE. Let's just take a look at forward PE. Yeah, 40s, around 40s, 50s, 70s. I don't want to own this. I want to have a large margin of safety. I want to buy stuff that's reasonable, a very high quality, that's reasonable priced. And our Fortinet is not just high quality. It does a lot of right things for me personally when I'm looking at companies to buy. It is trading at a massive discount right now. Not massive, but substantial discount. And also you're getting it cheaper than the market. So great opportunity for me. I think, I actually hope this goes down some more so I can load up some more. Let's take a look at return on invested capital, only 7%, and it's consistent. It was higher. It was negative for a long time. And yeah, just 2 years, I guess, 1.5 year, double-digit ROIC, and now it's been trending down since then. We're down at 7%. yeah, I'm not getting excited over this. Even if it drops, I would not want to buy it aggressively. This needs to drop a lot for me to like it. And if this drops by a lot, probably other companies such as Fortinet drop by a lot also. So I would much rather just buy Fortinet. But anyway, FCF yield, a bit more expensive than the market. Yeah, because this hasn't gone down like Fortinet. But anyway, that was it for a little bit of comparison here. You have stuff like, so these two, Palo Alto Networks and Fortinet, are direct competitors. But I would say overall, CrowdStrike is competing directly against Qualys, Fortinet, Tenable, and also Rapid7 combined. It's like a platform for cybersecurity. Qualys is trading at a lot cheaper price, but I might make a separate video. Forward PE 20. Growth is much slower, so we're getting below double-digit growth rate here. But yeah, they're doing a lot of buybacks, as you can see here. Shares change year over year. Very consistent in buybacks. Very high margins, same as Fortinet, but it's much cheaper and yeah, a bit slower growth rate. ROIC and ROCE not as amazing, but still very, very high. But FCF yield is also much higher, so we're getting it at a lot cheaper price. So if Fortinet keeps on dropping, I might just sell a little bit more of my Qualys and put Fortinet up there together. I might sell, let's say, 0.5% and put it on Fortinet, or more, let's say 80.8%, and having Fortinet as my bigger position here. But yeah, that was it, I guess. Hoping this drops a lot more so I could buy more. I'm very happy to own it. This is a very good opportunity, in my opinion. It rarely comes in a very high quality company like this. I don't know why this is swinging a lot more than Palo Alto Networks, but yeah, anyway. I'm here to make money. I buy low, I sell high. I'm looking for stocks that offer me this opportunity, and right now, this is an opportunity.